So let's talk about exchange-traded products, ETFs, ETNs, or ETCs. An exchange-traded fund, or ETF, is the common name that is used for all of these different investment vehicles, but there are essentially 3-4 different types. ETFs for exchange-traded fund, an ETN, which is an exchange-traded note, and the difference is in an ETF you have an ownership claim, in an ETN you have a debt claim, and then an ETC, sometimes they're called if they hold commodities or if the asset is a currency. And these look a lot like mutual funds, but they're kind of like a hybrid between closed-end funds and open-end funds. And so they're indexed, they're passive investment vehicles. So they don't pay managers, so they have very low fees, and so they're kind of like a passive or index open-end fund, except the shares trade, well, as it says, on an exchange. And so kind of like a closed-end fund, where you can buy and sell the shares of your fund to other members of the market. So not like open-end funds, which only trade once per day. They're kind of like closed-end funds in which they trade all day, every day. But they're index like open-end, like some open-ended funds. So here are the characteristics for ETFs. And again, the term ETF is generally the common term that's used for all these investments, and so I'll use that as well. So ETF characteristics, they are not actively managed, they're passively managed, so you know what they hold, and that'll be important in a minute. So they track an index, or they track a commodity or a currency, and they trade like stocks. They can be purchased using margin, or they can be sold short. Now, we know that closed-end funds, because they trade on a market and they have therefore a market price and they have a NAV, sometimes the market price or the NAV can differ, and they can be trading at a premium or they can be trading at a discount. Well, ETFs have a special situation which keeps them from trading at either a large premium or a large discount. They almost always trade very close to, at, or near the NAV. And here's how this works. There are these entities, which are essentially big trading companies, that are designated as authorized participants for the ETF. And so the ETF sponsor designates these special entities, the ETF sponsor designates authorized participants. They say, you are an authorized participant, you are an authorized participant. And there are usually a few authorized participants for each ETF. And the authorized participant can buy new shares from the ETF by delivering the underlying asset. So they can't pay money, but if it's an S&P 500 ETF, they can go out and buy all 500 shares of the S&P 500, deliver those to the ETF sponsor, and the ETF sponsor will deliver a share to the authorized participant. And we'll talk about why they want to do that as well. Or the authorized participant can go to the market and buy ETF shares, deliver those ETF shares to the sponsor, and the sponsor will then essentially redeem those shares and not give them money, but deliver the 500 shares that underlie the S&P 500. And this is important because if it is the case that an authorized participant buys a share or sells a share, that can create tax consequences for the people who own the ETF. But if they just deliver the underlying assets or receive the underlying assets in exchange for ETF shares, then this is not a taxable event. Okay, so why would they do this? Why would they allow for authorized participants? What's the point? And the idea is to ensure that the price equals the NAV. So what if the price of the ETF share is greater than the NAV? So if the price exceeds the NAV, then the underlying assets, the 500 stocks on the S&P 500, are cheap, and the ETF shares are expensive or dear. And so what the authorized participant can do, and remember this is a large trading company, is they can very, very quickly buy all of the underlying assets, all of the 500 stocks in the S&P 500, and then deliver the stocks to the ETF sponsor, and they'll receive an ETF share, which they then sell for more than what they paid for the stocks. And so they take cash, they buy stocks, they deliver the stocks, they receive an ETF share, which they then sell for cash. And so they go from cash to stocks to ETF to cash again very, very, very quickly, and they end up with slightly more cash than they started. And so this is an arbitrage, and this allows the authorized participant to ensure that if they buy the underlying stocks, those prices go up. If they sell the ETF share, the price goes down until those are equal. What if the ETF share is trading at a discount, if the price is less than the NAV? Now, the ETF shares are cheap and the underlying assets are expensive or dear. And so the authorized participant will buy shares from the market of the ETF, deliver the ETF shares to the sponsor, and then receive all of the underlying assets, which it then sells at the market price, which exceeds what it just paid for the ETF shares. And so therefore, this causes the price of the ETF share to go up, the price of the underlying assets to go down, again, until they are equal. If there's only one authorized participant, then the authorized participant may wait for the price to NAV spread to get very large. If there are multiple competitive authorized participants, they must act sooner. And through this mechanism, because they allow these authorized participants to engage in this activity, and this is very important, because the authorized participants know what's in the fund. They don't have to make public what's in the fund. They know what's in the fund because it's an index fund. It's just the 500 stocks in the S&P 500. This allows for a very, very close price between the market price for the shares and the NAV, the price of the underlying assets.